On September 24, 2026, JPMorgan Chase filed an 8K with the Securities and Exchange Commission confirming the relocation of its Midwest regional headquarters and approximately 7,400 associated positions out of its long-standing Chicago operations and into a consolidated campus in Plano, Texas. 56 years of continuous Chicago presence at the corner of Madison and Dearborn gone. And the city that has spent the better part of a century positioning itself as the financial capital of the American interior just lost approximately $500 billion in assets under management, custody, and treasury operations that had been administered out of its loop offices, along with an estimated $1.4 billion in annual economic activity that will not be recovered in the form it took. Now, I have watched a lot of banks move in my 95 years on this earth. I have watched institutions open branches in places nobody believed could support them and consolidate regional operations in places everyone assumed were permanent. I have watched the most rooted financial firms on the continent quietly reassess where they wanted to be 10 years from now and act on the answer. But what just happened between JPMorgan Chase and the city of Chicago is something I want to walk you through carefully. Because this is not a story about a bank moving 7,400 employees from the Midwest to Texas. This is a story about a city that watched its financial center erode for a decade, listened to its own incoming mayor describe the conditions of that erosion in public remarks, and is now staring at one of the largest Class A office consolidations in its history, wondering how the original arithmetic ever worked. And the people paying for those empty floors are not bank executives. They are the 7,400 workers who showed up to those desks every morning and the working families across Cook County who never had the option to leave. I have been sitting in the same office in Omaha, Nebraska for over 50 years. Same desk, same chair, same view of a parking lot that has not changed in any meaningful way since the Ford administration. I drink about 5 cherry Cokes a day, and my secretary stopped asking what I wanted in the morning sometime during the first Reagan term. I still live in the house I bought in 1958 for $31,500, and every single morning I show up to that office because there is nothing on this earth I would rather be doing. People ask me all the time why I never moved Berkshire Hathaway to Chicago or New York or anywhere else with more glamour, and I always give them the same answer. Because the business I was building did not care what zip code I was sitting in. The numbers worked in Omaha, so I stayed in Omaha. JPMorgan Chase maintained its Midwest headquarters in Chicago for 56 years for exactly the same reason. The numbers worked, and then they stopped working. And the moment they stopped, the company did what any rational corporation does when the arithmetic changes. It followed the math. Now, let me tell you how a small Manhattan bank founded in 1799 became the largest financial institution in the United States by assets. JPMorgan Chase did not become JPMorgan Chase by staying small. It became JPMorgan Chase by absorbing, over the course of 2 centuries, more than 1,000 predecessor institutions, including First National Bank of Chicago, which the company acquired through the Bank One merger in 2004 and which traced its own Chicago roots back to 1863. By 2026, the firm employed approximately 5,200 people in its primary Chicago commercial banking and asset management operations, with an additional 2,200 in supporting functions across the metropolitan area. The Midwest regional operation administered, by the company's own disclosures, approximately $500 billion in client assets across commercial banking, private banking, and treasury services. The aggregate annual economic relationship between JPMorgan Chase and the greater Chicago region, including direct payroll, supplier contracts, philanthropic giving, and the gravitational pull on adjacent professional services firms, was estimated by the Civic Federation in early 2026 at approximately $1.4 billion. JPMorgan was not just a tenant in Chicago. It was a structural pillar of the city's claim to be a global financial center, and its commercial banking presence in the Loop was the validation of a thesis that the city remained a credible home for major financial operations, and Chicago had 56 years to understand exactly what that pillar represented. Now, I want you to pay close attention to what happened next, because this is where my partner Charlie Munger's most important lesson becomes impossible to ignore. Charlie used to say, "Show me the incentive, and I will show you the outcome." Always the incentives, not the intentions, not the ribbon cuttings, not the speeches at the Economic Club of Chicago, the incentives. So let us look honestly at the incentive structure Illinois and the city of Chicago constructed for their largest financial employers over the last decade. And let me be clear at the outset, the people who built this structure were not bad people. They were responding to genuine fiscal pressure, a pension system that had been underfunded for 40 years, a public transit network that needed investment, public safety concerns that were entirely legitimate, and a housing affordability crisis affecting tens of thousands of working families. I understand every one of those pressures. The concerns were real. But over a period stretching from roughly 2017 through 2026, Illinois and Chicago assembled a stack of conditions that, taken individually, each had a defensible rationale, and taken together produced a mathematical conclusion the General Assembly and the City Council never quite stopped to calculate. There was the 2017 state income tax increase, raising the corporate rate to 7% from 5.25%. There was the city's 2020 imposition of a new lease transaction tax on high-end commercial occupancy in the Loop. There was the personal property lease transaction tax expansion. There was the cumulative weight of the state's unfunded pension liability, which by the first quarter of 2026 stood at approximately $144 billion, the worst per capita figure in the country, casting a permanent shadow over the state's long-term tax trajectory. There was the rise in commercial property assessments on Class A office buildings in the Loop, running approximately 38% higher than comparable assessments in Plano, Texas. And then, in the late spring of 2026, came the fatal detail. Mayor Zoran Mamdani, who had been elected on a platform that explicitly included a proposed financial transaction surcharge on commercial banking activity within the city, began moving that proposal through preliminary committee review, with a target implementation date of January 1st, 2027, and an estimated annual cost to the largest Chicago-based financial operators, including JPMorgan Chase, of between $180 million and $240 million per institution. Now, I want you to read that number the way the JPMorgan board read it in early summer of 2026. If you are sitting on the operating committee of the largest American bank with a team of advisors, and JPMorgan Chase has approximately the most sophisticated team of advisors in the financial services industry, you are looking at $180 million to $240 million in potential annual incremental cost on a regulatory window you do not control, in a city where your effective tax burden on commercial banking operations was already running materially higher than your costs in Texas, Florida, and North Carolina. You compare that figure to the cost of accelerating an existing Plano expansion, which the company had been building since 2017 and where state income tax is zero. Commercial property assessments run at roughly 41% of Chicago's per square foot, and there is no comparable financial transaction surcharge anywhere on the legislative horizon. The math is not close. It is not even an interesting question. The window to act is not after the surcharge passes. The window is now, while the relocation can be staged on the company's preferred timeline rather than executed under public pressure. Clear incentives produce predictable behavior every single time. What followed was not a single corporate decision made in isolation. It was a bank run. I want you to hold that image because it is exactly right. And when the depositor in question is itself a bank, the image has a particular sharpness. When depositors believe a bank is about to fail, they do not wait politely for official confirmation. The ones who move first lose nothing. The ones who wait lose everything. So everyone moves first. That is the structure of what has been happening to Chicago's financial sector for the better part of a decade. The largest financial employers in the city have been making the same simultaneous rational calculation JPMorgan just finalized, and they have been quietly relocating regional operations, shifting senior leadership, and withdrawing forward commitments before the next fiscal window closes. And the JPMorgan announcement, when it came on September 24th, did not arrive alone. Citadel, the hedge fund built by Ken Griffin, and for years the most valuable financial firm headquartered in Chicago, relocated to Miami in 2022. Caterpillar, founded in Illinois in 1925, moved its global headquarters from Deerfield to Irving, Texas in the same year. Boeing relocated its corporate headquarters from Chicago to Arlington, Virginia. Citadel Securities followed its parent firm. Tyson Foods consolidated its Chicago office back into Springdale, Arkansas. Northern Trust, the venerable Chicago-based wealth manager, has quietly relocated material portions of its operations functions to Tempe, Arizona. Conagra Brands, which had moved into the merchandise mart with great fanfare in 2016, began trimming its Chicago headcount in 2024. Walgreens Boots Alliance, headquartered in Deerfield, announced a significant restructuring of its corporate footprint. And now, the commercial banking giant that had administered hundreds of billions of dollars in Midwest assets out of its Loop offices for more than half a century has filed its 8K to consolidate into Texas. And in my experience, the names you can confirm publicly in any corporate migration are rarely the complete list. The estimated aggregate loss to Illinois from confirmed major headquarters and regional operations relocations since 2020 exceeds $1.8 billion in annual state revenue. I want you to sit with that number for a moment, $1.8 billion. That single figure, the annual loss from confirmed financial and corporate departures, exceeds the entire annual operating budget of the Illinois State Police. Now, I am going to tell you about the moment in this story that I find the most extraordinary. The moment that, to my mind, defines this entire situation better than any 8K filing or relocation announcement possibly could. August 20th, 2026. The Civic Committee of the Commercial Club of Chicago is hosting a quarterly business outlook session at the Standard Club. Mayor Zoran Mamdani, 3 months into his administration, accepts an invitation to speak. It is 35 days before JPMorgan Chase's 8K is officially filed with the SEC. 35 days. And standing in front of an audience of senior partners from every major law firm and financial firm in the city, in a venue specifically associated with the institutional memory of Chicago commerce, the mayor of Chicago says, in his own words from the published account of the remarks, that he is aware, and I am paraphrasing carefully from the reporting, that several of the city's largest financial employers have been engaged in active strategic reviews of their Chicago presence, and that the administration must, again, paraphrasing the reporting directly, find a way to advance its tax and equity priorities without accelerating outcomes that would harm the very workers those priorities are meant to protect. The sitting mayor of Chicago on a stage at the Standard Club 35 days before the largest financial sector departure in the city's recent history was officially filed, describing with measured accuracy the precise mechanism of deterioration that was already executing while he stood there and spoke. I have been in business a long time. I have sat across the table from a lot of extraordinarily capable people, and I will tell you honestly, I cannot think of a parallel, a chief executive publicly describing the failure conditions of his own administration's flagship policy while the failure was already in motion, while the very ordinance he was elected to advance was simultaneously being processed through preliminary committee review on the schedule he had set. That is not contradiction. That is a governing situation so thoroughly documented in real time that it almost defies analysis. Now step away from the executives in Manhattan and Plano entirely for a moment. My father, Howard Buffett, was a congressman from Nebraska and a deeply principled man who taught me that the measure of any economic policy is never what it promises on the day it is announced. It is what it delivers to ordinary people living inside it 10 years later. So let me tell you about Pamela Okafor. Pamela is 47 years old and has worked in JPMorgan Chase's Chicago Commercial Banking Operations Group for 16 years, the last 4 of them as a senior Treasury Services analyst supporting middle market clients across the Great Lakes region. She lives in Bronzeville with her husband, who is a CPS middle school teacher, and her 2 children, ages 14 and 11. They bought their house in 2014 for $287,000, refinanced it in 2021 when rates dropped, and were on a schedule to have it paid off in 2034. The September announcement gives Pamela and her colleagues the option to relocate to Plano at company expense or accept a severance package that her HR representative estimated would cover, on average, between 5 and 8 months of household expenses for affected employees. Pamela will not be moving her family to Texas. Her husband's CPS pension vests in 2029. Her older daughter is in her first year at a selective enrollment high school. Her mother in Hyde Park is 81 and requires regular help. None of that survives a relocation. The $1.4 billion in annual economic activity that JP Morgan generated in Chicago was not an abstraction to Pamela. It was the difference between a mortgage retired in 2034 and one that quietly slips into uncertainty. It was the difference between a daughter who completes selective enrollment on schedule and one whose educational continuity is disrupted. She did nothing to cause this. She had no seat at the table when the financial transaction surcharge was being drafted, and the gap that 7,400 banking positions opens up does not quietly disappear when the floors empty out. It falls straight down onto the people who stayed. In my experience, damage of this kind moves in distinct layers. One regional headquarters consolidates. The corporate parent surrenders multiple floors of Class A office space and reallocates the supplier contracts to vendors in other regions. The city of Chicago loses, by the projection of the Civic Federation, approximately $73 million in annual direct tax revenue from the operation, its employees, and their related spending, plus an estimated additional $94 million in indirect business tax receipts from the legal, accounting, technology, and consulting firms that orbited the JP Morgan account in Chicago. Cook County loses property tax revenue on Class A commercial floors whose vacancy rate just rose materially. The two restaurants on the ground floor of the building, which together employ 51 people and built their lunch business around the banking tenancy, are now looking at a customer base that is contracted by more than 7,000 people. The local United Way of Metropolitan Chicago, which counted JP Morgan as one of its 3 largest corporate donors, is now modeling a budget without that commitment. The Art Institute, the Lyric Opera, the Joffrey Ballet, and the Field Museum, all of which had multi-year giving relationships with the company's Midwest operation, are now adjusting their development projections. That is 3 full levels of damage from a single regional consolidation. Multiply that structure across the 9 confirmed major financial and corporate relocations out of Illinois since 2020, and you begin to understand the actual magnitude of what has happened to the state's professional employer base. And Chicago is not running this experiment alone. That is the part I need you to hear clearly. New York lost a steady stream of financial firms to Florida and Texas through 2024 and 2025, with the Florida Department of Economic Opportunity reporting approximately $341 billion in cumulative financial firm assets relocated from New York to Florida since 2020. California lost its single largest corporate headquarters concentration in modern history when companies including Chevron, Tesla, Oracle, and Charles Schwab all consolidated out of state. Minnesota's corporate income tax structure has triggered quiet conversations among at least 4 Fortune 500 headquarters currently based in the Twin Cities. Connecticut watched General Electric leave Fairfield for Boston in 2016 and has spent the subsequent decade attempting to rebuild its financial sector tax base. The same template, the same incentive structure, the same mathematically predictable outcome, running on a slightly delayed timeline in each city. This is not 5 separate municipal stories. This is one national story about what happens when the incentive to relocate becomes structurally more powerful than the incentive to stay. I have made a lot of investments over the course of 70 years of reading financial statements, and the single most important lesson I have learned across all of it is this: you cannot earn your way out of a structural mistake by hoping that the people most affected by it will not notice what you have done. They notice. They always notice. And when they have the means and the mobility to act on what they notice, they act without exception, without sentiment, without waiting for permission. Chicago is now attempting to figure out how to replace a financial base that has been quietly walking out the back door for the better part of a decade. The bank, whose Chicago roots trace back to 1863, is consolidating its Midwest commercial banking operations into a campus 30 miles north of Dallas. Pamela Okafor is updating her resume for the first time in 16 years. The Civic Federation is modeling Cook County's 2028 budget around a Class A office vacancy rate that just took another step upward. And the mayor who described the precise mechanism of this departure on a stage at the Standard Club 35 days before the 8K was filed is preparing his next budget address. I stayed in Omaha my entire life because Omaha never gave me a reason to leave. That is the only reason any person or any business stays anywhere. Not loyalty, not habit, not the sentimental memory of a 1863 founding charter or a 2004 merger. The math. Change the math and you change the behavior every single time, without a single exception in the history of commerce. The money never sits still when you announce publicly where you intend to send it, and capital never stays in a place that has stopped making the arithmetic work, particularly when the capital in question is a bank and the place in question has the worst pension liability per capita in the country. If you are watching this from a city where these conversations are just beginning, where the council is debating its own financial transactions, surcharge, or its own commercial occupancy tax, or its own corporate rate adjustment, you are not watching Chicago's problem from a safe distance. You are watching your own situation playing out one election cycle ahead of you. If you have seen banking floors quietly thin out in your downtown, neighbors stop talking about promotions they used to mention or job postings. Simply stop appearing the way they once did. Leave a comment below. Tell us what city you are in, what industry you work in, what you are actually seeing on the ground. Subscribe to this channel because this story is nowhere near finished. The numbers are still moving, and wherever the numbers go, the story follows. They always do.